3. Investing does not need to be complicated. Simple strategies win.
You can fully diversify a portfolio from the risk of any specific company just with 4 or 5 different funds, mutual funds or ETF, exchange traded funds.
Baskets of companies.
Baskets of companies. And there's active versus passive investing. And what we mean by that are active versus passive funds. And so an actively managed mutual fund is one where there's a excuse me, a mutual fund manager or management teams that are trying to pick the winners and losers of companies and buying and selling and doing that all the time, incurring trading costs for one. But the big thing that we found out, I don't know, several years ago, over a decade ago, is that these actively managed funds, actually, most of them don't do as well as the indexes. You know, like if a fund is investing in large cap United States stocks and you compare that fund to the S&P 500 index, the 500 largest companies on the New York Stock Exchange, most of those funds underperform those indexes. And so because of that, we invest in what we call passively managed funds or unmanaged funds, baskets of stocks, because then we don't have to trust a fund manager or management team because they don't have a very good proven track record. We have some proof of that Jesse's going to show you.
Yeah, Standard & Poor's does a study comparing actively managed mutual funds to their benchmark indexes. Benchmark means their comparative indexes every year. And this last one that I have is from 2021, but it shows like almost 20 years of, 20 years of returns. And the companies, what's in the orange is the percentage of actively managed mutual funds that underperformed their indexes.
And in the blue is the percentage of those actively managed funds that beat the indexes.
So over a 20-year period, look how crazy this is. So for large cap growth funds, this would be a lot of the funds in the S&P 500, a lot of funds on NASDAQ probably. 99.71% of those actively managed funds underperformed their relative indexes.
Yeah.
That's crazy. So the reason why we share this is not just if you're investing in mutual funds. It's that if you're managing your own money or you have somebody managing your money, they might be doing a similar thing where they're trying to basically make and manage their own mutual fund with a whole bunch of stocks. We've seen people come in with statements like this from different advisors where they have, you know, sometimes almost 100 different stocks. Basically, they have their own mutual fund that they're trying to manage to outperform an index. And even people who are really smart, professional, these people who manage these mutual funds are like the cream of the crop of financial advisors. Like they are awesome and they still can't beat the indexes most of the time. So just if you keep it simple, you can win.
Right.
You're more likely to win.